You live in Beijing most of the time, and you're using money raised perhaps in the US to allocate to China. How difficult has that become?
Harder and harder. And we saw this coming, so we diversified our capital base 5-6 years ago, but today China is nearly uninvestable for US private capital.
Do you think that is going to ratchet up a level? Do you think any of these sorts of missions coming from Janet Yellen and Blinken going to China could dial that back a little bit? Or more realistically, do we worry about China's giants' access to US IPOs and the like?
I think from a capital markets perspective, the U.S. is still open, although it's closed for everyone right now. I do think, though, it'll be harder and harder to raise U.S. capital, particularly capital that has institutional ties to pensions, endowments that have some kind of a federal funding basis, so DARPA grant recipients or others, because there's this fear that that funding will be cut by some of these executive actions that you foreshadowed.
I mean, goodness, we just saw one company that's putting manufacturing in Kentucky, for example, no longer getting a grant from the Biden administration because of their links to China. What, therefore, does U.S. capital miss out on by not being able to access China?
You miss out on what will soon be the world's largest market and is already in many key verticals the world's largest market. There's an opening void and a lack of comprehension around that market. So it's really an arbitrage opportunity today to access growth that is being shied away from for non-financial reasons. So accessing that China alpha in a way that is politically safe is still very much a growth story for the coming decades.
What's interesting is, of course, all of this has been, in many ways, trying to be articulated that this is about nearshoring, or indeed making sure that your supply chain has resilience, as we saw it so break down during COVID. When I bring up Microvast, which is now no longer able to do a battery plant in Kentucky because of its relationship with China, when you see the moves by China to limit certain metals to the US, how much of a problem is that going to be? Or can the US, like it's trying to do with chips, start to ensure that they can also access rare earths quickly so the supply chain isn't disrupted for the next 4 years or so?
Certainly both sides are trying to wean themselves off of dependence on the other and become more self-sufficient. The U.S. on the core inputs and rare earths and other commodities, and China on the chips itself. I think that these bans on gallium and germanium are just the first volley of Chinese future restrictions in this tit for tat between the two countries. And China has a significant share of the deposits of these rare earths across many different use cases, and also has the manufacturing, the extraction, all these types of infrastructure investments that will take years for the U.S. to ramp up and actually execute upon in order to wean itself off of Chinese dependence.
What everyone's been very much animated about of late is AI, generative AI, the focus back here in the US on the excellence that's being developed, but also what's happening when you're there in Beijing. What are you seeing in terms of generative AI and AI capabilities over there?
It's a huge investment theme. It's attracted most of the capital invested over the first couple quarters of this year. It's still very hard to determine who's going to be the winner. Largely people that have a proven track record and existing success in other businesses. For instance, the founder of Meituan were able to attract hundreds of millions of dollars at billions of dollars of valuations. And it still scares me quite a bit because it's unclear whether or not they really have the execution capabilities and the market fit in order to execute upon them. So still very much TBD.
Where is the AI expertise from your perspective in China?
Well, China still obviously produces the world's largest crop of STEM graduates. It has a very deep base of talent to draw upon and the largest homogenous data set to work with. And so there's still huge opportunities to take that and apply it to retail, financial services, education, and all forms of other enterprise outputs.
When you're saying it's harder and harder to raise US capital to allocate in China, who is wanting? Who's going to take the place of that US capital?
So we're seeing a huge geopolitical shift of emphasis from particularly markets like Southeast Asia and the Middle East towards China, markets that were under-allocated to China historically and are now opening with arms wide open for Chinese businesses as well as capital flows cross-border. We've seen actually a push-off of U.S. economic and political interest, particularly in the Middle East, as they work to embrace China.
What about your role, therefore? You're sticking there, you're remaining committed to the assets that you allocate. How do you see your movement back and forth? I mean, you're here in New York for the next month or so.
I'm an American by birth, but certainly I believe that a world is better where these two markets work together, and particularly as it pertains to climate, disease, all kinds of other major phenomena forcing themselves on our world. We have to work together. But there's an opportunity now for those of us that do deeply understand China and also have deep relationships here in the U.S. in the political and economic field to help investors in the United States navigate all of these geopolitical risks in China and still access that high alpha.